Herzlich willkommen aus dem Energiestudio Berlin zur Vorstellung des neuen Gasmarket Reports der Internationalen Energieagentur. Heute mit der Analyse zum vierten Quartal 2025, zum Gesamtjahr und mit einem Ausblick auf 2026. Mein Name ist Charlie Grüneberg, ich leite die Kommunikation bei die Gas- und Wasserstoffwirtschaft und ich freue mich sehr, dass Sie mit uns hier dabei sind. Der weltweite Gasmarkt verändert sich tiefgreifend, weniger Nachfragewachstum, massiver LNG-Ausbau und ein strategischer Umbruch in Europa. Die IEA erwartet, dass der Gasverbrauch dauerhaft unter Vorkrisenniveau bleiben wird. Dagegen setzen Länder wie China, Indien oder auch viele südostasiatische Staaten weiter auf einen Ausbau. Der Report wirft aber auch einen Blick auf die Entwicklung kohlenstoffarmer Gase und zeigt, wo sich neue Märkte öffnen, rund um Wasserstoff, Biomethan und CO2-Abscheidung. Was bedeutet das für die Rolle Europas im globalen Wettbewerb und wie positioniert sich Deutschland? Wie verschieben sich die geopolitischen Kräfteverhältnisse auf dem Gasmarkt? Dazu begrüßen wir auch heute wieder unsere beiden Experten der IEA, Gergely Molnar und Frederik Ritter. Herzlich willkommen und vielen Dank, dass Sie wieder bei uns sind. Die Veranstaltung wird aufgezeichnet. Die Präsentation und der Link zur Aufzeichnung gehen Ihnen im Nachgang per Mail zu. Und wenn Sie Fragen haben und sich später an der Diskussion beteiligen möchten, was wir natürlich sehr begrüßen, dann nutzen Sie gerne die Handhebefunktion oder schreiben Sie Ihre Frage in den Chat. And now I will switch to English. Welcome again, Gergely and Frederik. We are very glad to have you back with us. Let's take a closer look at the future of gas in a world that is changing fast geopolitically and climatically. You will walk us through the latest market outlook, including slowing global demand, the coming wave of new LNG supply, and the big question, is Europe's gas consumption in permanent decline or just taking a breather? Gergely Molnar and Frederik Ritter, the floor is yours.
Hey Charlie, many thanks for your kind word of introduction. Indeed, it is a great pleasure to be here today. My name is Gergely Molnar, and I'm very pleased to join today's webinar together with my colleague Frederik Ritter. We just published a week ago our Gas 2025 report, which is available free of charge on our website, iea.org. And today's presentation will be very much structured along the key takeaways of that report, which includes an overview of recent gas market developments, medium-term outlook to 2020, 2030, as well as an outlook related to low-emission gases. So in the first part of today's presentation, we will just have a quick overview of recent gas market dynamics for the first 3 quarters of the year. And I think that when we are looking at the evolution of natural gas prices, we see that 2025 has been, in a way, a transition year for natural gas markets. On this slide, we are presenting the evolution of Asian spot LNG and European hub prices since the start of 2024. The dark blue line indicates TTF, the European benchmark. The light blue line is JKM, a key marker for Northeast Asia, and the gray area between the two is the spread. And I would like to make 3 comments on prices. The first one is that when we are looking back at the first half of 2025, we see that both TTF and JKM were trading well above their last year levels. TTF was up by around 40%, while TTF was trading 30% above its last year levels. And we believe that this has been very much supported by the tighter market fundamentals, and we will discuss this in a minute. LNG supply has been growing, but this has been partly offset by the lower piped gas deliveries to the European Union. And in addition to that, geopolitical tensions provided additional short-term price volatility, especially in June during the Middle East crisis. The second point is related to the new market trends which have been emerging in the third quarter of the year, when we started to see that both TTF and JKM fell below its last year levels. And in our view, this is very much supported by the improving availability of LNG supplies. Global LNG production increased by a staggering 9% year on year since July, which is quite a strong addition. And of course, this is putting some downward pressure on the prices across the LNG importing markets. The third comment I would like to make related to prices is the spread. When we look back at 2024, we see that JKM was trading about $1 per MMBTU above TTF price levels, and this has been supported by the relatively strong Asian gas demand, as well as by the fact that in Europe we had rather comfortable storage levels after a relatively mild winter season. Now, this completely changed in 2025. We see that the spread practically disappeared. And this has been due to Europe's stronger LNG appetite, which was driven by higher demand, but also stronger storage injection needs. And as we will discuss this in a couple of minutes, this incentivized a rather strong inflow of LNG supplies towards the European shores. On this slide, we are giving a closer look to the supply fundamentals characterizing the first 3 quarters of the year. On the first bar, we show that global LNG supplies increased quite strongly by over 5% in the first 3 quarters of the year, adding more than 20 BCM of incremental supply to the global market. And I would like to highlight that this has been very much driven by North America, and in particular by one project in Louisiana, Plaquemines LNG, which alone accounted for about 65% of incremental LNG supply in the first 3 quarters of this year. In addition to that, we have seen a continued increase in pipe gas deliveries from Russia to China via the Power of Siberia pipeline system, which added around 5 BCM of additional volumes towards the Chinese market. Now, this growth has been partially offset by the lower pipe gas deliveries towards the European Union from Russia due to the halt of the transit via Ukraine, but also from some other pipeline suppliers, including Norway, due to a higher maintenance. And in addition to that, we have seen quite a strong increase in EU storage injection needs since April. They have been up by 35% year on year, which further tightened the summer market, and as such limited the natural gas volumes which are available for actual demand growth. And this had, of course, implications also on global gas consumption patterns. When we are looking at the latest estimates related to demand growth, we see a clear slowdown. On this chart, we are presenting the year-on-year change in natural gas demand in the first 3 quarters of the year across the key markets we are very closely monitoring. This includes Asia, Europe, North America, Eurasia, and Central and South America. And our estimates indicate that gas demand growth across these regions slowed down from almost 3% in 2024 to just around 0.5% in the first 3 quarters of 2025. I think what is quite visible here is that most of that actual growth has been concentrated in the European market. where we have seen a 5% increase in natural gas consumption, reversing the trends of the previous years. And this growth has been partly driven by a colder Q1 weather conditions, but also very importantly by the underperformance of wind and hydropower generation, which supported a stronger increase in gas-fired power plants output, which has been increasing quite in a robust manner in the first 3 quarters of the year. In contrast, we have seen in Asia a decline in natural gas consumption, a decline of around 0.5%. And this has been due to a combination of factors, including a weaker macroeconomic environment, the effect of the relatively high spot LNG prices, and also some weather effect, including the relatively mild Q1 in Northeast Asia. Now, when we are looking at the global LNG flows, I think it should be noted that in contrast with 2024, we have seen that China reduced quite significantly its LNG imports in the first 3 quarters of the year. And actually this trend continues into October. And on this slide, we are presenting the key drivers behind that. First, China's natural gas demand was relatively flattish over the first 9 months of the year. And once again, this is partly due to the weaker macroeconomic environment, partly due to the higher spot LNG prices. The second factor is the ramp up of the Power Siberia pipeline system we already mentioned. It added around 5 BCM of additional gas supply to China. And also, very importantly, China's domestic natural gas production increased by a robust 6% year-on-year in the first 3 quarters of the year. And when we combine these factors, we see that they, in a way, squeezed out LNG from China's gas supply mix. China's LNG imports fell by around 17% compared to last year. And this has been partly due to lower nominations on long-term contracts, which we estimate that it declined by around 10%. But also, very importantly, we have seen that Chinese buyers withdrew practically from the spot market, and China's spot LNG procurements dropped by a whopping 33% compared to last year. And this, in a way, also facilitated the ramp up of LNG inflows towards the European market, where we have seen, in a way, the opposite of market dynamics. As we mentioned, European gas demand was increasing by around 5%. Storage injections were up by 35% year-on-year during the April to September period. And in addition to that, we have seen a decline in piped gas supplies from Russia, Norway, but also a small decline from Azerbaijan. So when we combine these factors, we see that Europe needed to increase quite strongly its LNG imports, which grew by more than 25% year-on-year to an all-time high of 127 BCM in the first 3 quarters of the year. Now, before turning to the medium-term outlook, as we are heading into the heating season, please allow me to share a couple of considerations ahead of the European winter. On this slide, we are presenting 3 key factors to be considered. One is the state of European underground stock levels. At the moment, EU storage levels are standing about 13% below their last year levels, or about 12 BCM below their last year levels. And this is despite the very strong increase in storage injections. The good news is on the second chart of this slide, is that we expect a relatively strong increase in LNG supplies over the 25-26 winter season. We do expect that LNG supplies would increase by more than 7% or over 20 BCM, very much supported by the continued ramp up of LNG facilities in North America, including Plaquemines, LNG Canada, but also the startup of the Golden Pass LNG terminal, the Train 1, as well as some smaller facilities in Africa, such as Tortue FLNG and Congo FLNG. In addition to that, we do expect that European natural gas consumption will moderate compared to last year, partly due to on the assumption that we will see a return to more average type of wind speeds after last year winter, when we had quite a slowdown in terms of wind power generation. So when we combine these factors, we see that supply-demand fundamentals indicate or could indicate a calmer gas winter. Now, this picture can be easily distorted by adverse weather effects, such as a colder winter or a continued underperformance in renewable power generation. And the other risk factor is, of course, the geopolitical tensions and the continued attacks on natural gas infrastructure. So I think there is absolutely no place for complacency, even if the market fundamentals are indicating calmer waters ahead. Now, with that, we would like to move to our medium-term outlook, and I will pass the floor to Frederick in a minute, but please allow me just to say a couple of words on the overall framework, analytical framework underpinning our medium-term outlook. The starting point for us has been the supply side, where we see a very strong increase in global LNG liquefaction capacity, up by 300 BCM per year by 2030. We do apply various rating factors to the capacity, including ramp-up factors, utilization rates. We also take into consideration mounting feed gas issues at certain legacy producers. And when we combine these factors together, we see that the net supply for LNG would be around 250 BCM by 2030. This is a huge number for our LNG industry, equating for almost half of the current global LNG trade. But I also would like to note that if you put this into broader perspective, we also see that this is just around 7% of Asia's thermal coal power consumption today. And the critical question for us when we were developing our medium-term outlook was to see where all this LNG, this 200 BCM, where it will be consumed and what will be the implications for the market. What we clearly see is that there will be a shift towards a buyer's market from the seller's market we have seen for the last few years. We did develop two cases. The first one is a more static basic case, which does rely on a price view which was informed on the prevailing forward curves. And Frederick will explain this in greater detail, but in that base case, we see that global LNG demand could increase by around 170 BCM. So not sufficient to absorb all the new supply which is expected coming to the market. So to address that, we also include in the analytical framework a more dynamic high case. In that case, we see that Asian and European gas prices are moving closer to the short-run marginal cost of US LNG. This is our assumption that in that case, they would be moving towards that range of short-run marginal cost of US LNG. And this would stimulate additional demand, especially in the price-sensitive Asian markets. And this would help to balance out the global gas market and help to absorb the coming LNG wave. And with that, I would like to give the floor to my colleague, Frederick Ritter. Thank you.
Thanks very much, Gergely. Hopefully everyone can hear me well now. So yeah, thanks for this introduction to the framework, of course, around our modeling exercise and the approach that we've taken for our medium-term outlook. I think this also gives us a useful overview of the key points that we'll be touching upon in this section, and we'll be going into more detail with. And additionally, the thing is that we'll be showing some of these results from both the base case and the high case in these next slides. So it's good to keep in mind what these cases correspond to in terms of elements on which we've built them. Now, Gergely touched upon, the one of the most, if not the most, structuring elements in our outlook to 2030. I think we need to start from this point to understand the shift in context that we've just talked about, that the market is expected to be dealing with in these next few years. This first section of the webinar today, we've covered the sort of progressive emergence from the 2022-2023 crisis years, and we're turning here into this next phase into which the global gas market is set to be moving. So around 390 BCM of LNG export projects reached FID in the period from 2019 to October of this year, 2025. We remember 2019 as being the single most important year for FIDs thus far. And so we're facing essentially the largest liquefaction capacity addition wave these next few years for any comparable period of time in the history of the LNG market. We expect, Gergely mentioned, around 300 BCM of liquefaction capacity to reach the market by 2030. This is based on projects that are either under construction, that have taken FID, and that are working towards delivery. And this is compared to 2024 levels, of course. And in turn, we expect this to translate to about 250 BCM per year of incremental LNG supply by the end of the decade, which, as Gergely said, equates to close to half of the global LNG trade in 2024. These are significant volumes that we're talking about, and we expect these to really shift market conditions significantly compared to what we've been, or those that have been dominating over these past few years. Now, most of this capacity will be driven by the United States and Qatar. Together, they account for around 70% of capacity additions, liquefaction capacity additions, out to 2030, which will essentially cement their position as the world's two largest LNG suppliers. There are these are the two sort of regions where we see a vast, concentrated and relatively low-cost resource basin, and these are markets that are really pushing to develop both this resource and the exporting capabilities. Just as a note, in this North America grouping that we're showing here in the chart in the light blue, we also have projects in Canada, we have projects in Mexico as well. In the Middle East grouping, there are also projects for in the United Arab Emirates and in Oman, for example. And projects are, of course, being developed outside these two regions, and they are key in this market balance that we're building out to 2030. But this capacity is simply, the smaller order of magnitude when we look at the numbers. Now, let's turn to how we see the demand side of this LNG equation shaping up in these next few years on this slide. So Gergely outlined our base case and high case structure a bit earlier, and here we start to see this playing out in the forecast numbers. In the chart on the left, we're showing incremental LNG demand out to 2030 by region and by case. We've got up to around 250 BCM of incremental demand in the high case, which corresponds to growth of around 46% from 2024 levels. The base case corresponds to growth of around 34% in LNG supply and demand growth from 2024 levels. Now, the nature of LNG and the LNG market means that the impacts of this supply wave will, of course, be felt globally. But when we look at the numbers in both the base case and the high case, the vast majority of incremental LNG demand is set to materialize in Asia, which is already today the largest LNG demand region today. And we see this trend growing out to 2030. Europe is expected to see the next largest gain on the demand side. Gergely will tackle this deep dive on Europe in a few slides from now, so you'll see how this piece of the puzzle fits into European market dynamics. After that, we have the Middle East and Africa, which are also expected to see gains that are more marginal from a global market standpoint, but nevertheless significant for their own market size. In the Middle East, these are, for example, markets that will see growing demand for gas, but don't necessarily have that resource base. In Africa, this is essentially driven by tightening gas market fundamentals in Egypt, although a good chunk of this upside has already been visible thus far in 2025 compared to 2024 numbers. Now, the chart on the right drives an extension of this key point in the LNG import picture. What we're showing here is the share of total incremental gas demand in these different geographies that is expected to be serviced by LNG, and the share that is expected to be serviced by other supply sources, so essentially domestic production or pipeline imports. And what we see is that at the global level, we expect LNG to account for broadly half of demand growth to 2030. It varies a bit, of course, across the two cases, but we can talk broadly about 50%. But when we focus on Asia, we see that this share is quite a bit higher. We're closer to 70 to 75% of demand growth, gas demand growth, being essentially serviced by LNG. So this is, of course, depending on the case, 70 to 75%. So in the left-hand chart, what we see is that Asia accounts for the majority of LNG demand growth. And on the right, what we see is that LNG accounts for the majority of Asian natural gas demand growth. So both of these elements are intimately connected in our forecast. LNG has a global impact, of course, but it also acts particularly as an enabler of gas demand growth in Asia. Now, before we go further into a regional deep dive on the next slide, let's stay a moment longer on the global picture to take a look at how we see global gas demand evolving in these next few years, both by region and by sector. Let's focus on the charts on the left first. Here we see the breakdown of incremental demand by region and for both the base case and high case. Total gas demand, global demand for natural gas, increases by around 9% over this period in the base case and around 11% in the high case, which is a total of around 400 BCM and 470 BCM, respectively. This translates to an average annual growth rate of around 1.5% and 1.7% in these two cases, which is slightly higher than what was observed over the 2018-2024 period. So what we see is that we're forecasting continued robust growth in the global gas market through the end of this decade. Regionally, Asia is the main driver on the demand side. This matches with what we saw in the previous slide regarding LNG demand as well. But here, Asia is only, and I put only in quotations, of course, it's only about 50% of the story. It's by far the largest element, of course, and this is the reason why we'll focus on this region for the next few slides. But there are other key demand growth stories that need to be taken into account. The Middle East is one of these. It's the next most significant one. Here we see demand growing by around 17% by 2030 in the region, essentially driven predominantly by the ramp up of oil to gas switching in power generation. This is, of course, a phenomenon that is already underway, but we expect it to continue driving gas demand growth in the region. In North America, the section in red, power generation is again the primary driver of demand growth, as growth somewhat tapers, we'll say, in other sectors, and incremental end-use demand for electricity drives this need for extra gas burn in the power sector. So what we're taking into account here is, of course, artificial intelligence applications, data centers that are also part of this growing trend, for example. Another demand driver in North America is the energy sector own use, linked to essentially growing gas and demand, gas and oil production, as well as to the energy needed in the liquefaction of gas for LNG imports. Now you'll notice one outlier here, Europe, but again, let's put this aside for now, as Gergely will tease out these insights for this European market in a couple of slides from now. Let's instead turn to the chart on the right here, which is showing the split by sector. I've already evoked some of the sectoral drivers in some of these regions, but globally, what we see is that power generation and industry are the fundamental drivers of gas demand growth in our outlook. These are the two sectors that can be quite price sensitive, of course, but that also offer key demand growth possibilities on the dual fronts of, number one, coal and oil to gas switching, and number two, simple organic activity-led demand growth in various markets around the world. So now, given the picture that we've seen, particularly in the chart on the left, and the importance of Asia in demand growth, I want to dive into this region for a couple of slides to better understand how this is built up and to highlight what this can imply for the global markets. I think 3 points warrant a little bit of focus, or warrant the focus on Asia here. Asia is expected to be the fastest growing region in our outlook. It will be the largest incremental demand driver in the outlook, which is nearly half of global growth, as we mentioned. And the third point is that Asia is on a trajectory to become nearly the largest gas-consuming region globally, essentially broadly on par with North America by 2030 in our high case. So when we take, we take this high-level view, we understand the importance of this region and the reason for diving in a little bit deeper. The issue is that despite all of this, or despite these high-level trends, this somewhat hides the fact that the region is made up by many different markets that are at different levels of maturity with respect to the role of gas in their energy mixes. China accounts for around half of Asian gas demand growth in both cases. Although gas is not necessarily a huge vector in the Chinese energy system, China is a huge element in the regional and in global gas dynamics. So China makes up around half of demand growth in Asia and around a quarter of demand growth globally. India makes up a smaller share of Asian incremental demand, but it is also a much smaller market than China today. What we see, though, is that in our high case, we've got around average annual growth reaching close to 7% per year, which is among the fastest paces across Asia, a very dynamic market. Other emerging Asia, as usual, is a bit of a tricky grouping, but we can broadly describe these markets as rather price sensitive on the one hand, but also very dynamic in terms of economic growth and with significant potential when it comes to gas demand growth. In the next couple of slides, we'll dig a little bit deeper into the sectoral drivers. But finally, mature Asian markets, this is Japan, Korea, Taiwan, for example. These markets see more subdued growth over this period, but growth nonetheless. This is something that we would expect from more mature markets with a higher penetration of gas already. They're at a different phase of the curve in terms of role of gas in the energy system. Now, on the next slide, looking at the sectoral drivers will give us a little bit more context into these growth prospects and to understand what's driving these fundamentals. Now, the first thing here is that we saw a few slides ago that industry and power generation are the motors behind gas demand growth globally. And we see this again reflected when we focus on Asia. So in China, industry and power generation are set to account for similar shares of growth. This is around 30% each. The deployment of renewables and the electrification of end uses remain sort of structuring and limiting elements in the Chinese market, of course. Growing electricity demand, however, gives space for power sector gas burn to grow over this time. Coal remains a relatively cheap fuel. We can't ignore this, of course, but varying regional dynamics and a general policy push or support are expected to help increase gas use as a cleaner burning fuel in the power sector. Again, despite electrification of industrial processes and a more cautious approach to coal to gas switching in industry, we still see this sector as providing a significant source of upside to gas demand. We still see a degree of switching away from fuels like coal and oil, and there is, of course, an element of overall economic activity or growth in economic activity. What we see is that there's also a significant chunk for other in China, which includes gas use and transport. Over the past couple of years, we've seen a fast ramp up in sales of LNG fuel trucks, essentially heavy duty vehicles for long distances and carrying heavy payloads. Sales numbers can be volatile, of course, depending on the month, depending on the year. But what we see is that the fleet has grown quite significantly, and there has also been the required build out of liquefaction and distribution infrastructure domestically in order to support this growth. In India, the city gas distribution network is undergoing the largest expansion of its kind anywhere in the world currently. And it's set to support growing demand for natural gas in transport. This is the biggest factor behind the other category again, as well as in small industry and commercial applications. Industry is that other keyword here. It's the other big factor, accounting for over 40% of the total upside in our high case. Other emerging Asia is where we see a power sector taking on an even greater role in driving demand. These fast-growing economies also have fast-growing power demand, and we see gas as having a key role in supplying this demand, following a growing renewable production load, of course, and offering sort of pollution and emissions advantages compared to coal. However, something that I didn't mention earlier, and that I think we need to note in order for this gas demand to materialize, especially given the significant share that is expected to come from LNG. So for this gas demand to materialize, we do expect there to be a need for further infrastructure investment, particularly on the LNG import capacity front. But we need to think also about the infrastructure and the policy that comes into play to get a molecule from a regasification terminal to a power plant to an industrial consumer. Just one word on mature Asian markets here. The power sector is key. This is due to electricity demand growth overall being a little bit higher than expected in previous years, and also a generally slower return or ramp up of nuclear generation in these markets. Now, we've already touched on the role of LNG in this region, but I do want to come back to this in one final slide for this medium-term section. What we see is that LNG has a key role in enabling demand growth globally, and in Asia even more so, particularly in the case, in our high case, which describes a lower priced market situation and market environment. But the flip side to this is that Asian markets are set to become increasingly reliant on LNG along these growth trajectories. And this is a product of tapering growth or even declining growth in domestic production, matching up against growing overall gas demand. So in the chart on the right, what we see is that gas consumption, what we're showing is essentially the share of gas consumption expected to be covered by LNG. And what we see is that it's on the rise in all of these different individual markets. In China, the increase is a little bit more modest, given the importance of domestic production and its continued growth. I think I saw a question in the chat a little bit earlier, which alluded to this question of what is the role for domestic production in China. Today, domestic production accounts for around 60%, close to 60% of Chinese gas demand. We expect this share to remain above 50% in our outlook, and quite a bit above. But we do expect growth rates in domestic production to slightly taper in the Chinese markets. But India, on the other India and the other emerging Asia markets, we see declining domestic production, so a bit different to the situation in China, particularly in the latter category in emerging Asia, where resource basins are aging and replacing these resources take time and it's relatively costly. And this essentially opens the door for LNG to play a bigger role with time. And what we see is that the flip side is that these markets are set to play a growing role in the global LNG market as well. So it's a push and pull that will continue to evolve these next few years, especially in out to 2030. And we expect this to be central in determining exactly how the global LNG market balances out. So on this note, I'll turn it back over to Gergely for a focus on Europe.
Fredrik, thank you so much for giving such an in-depth overview of this dynamic region. And now let us turn to a somewhat also dynamic region, but maybe in the opposite direction. Let us have a closer look to the European picture. On this slide, we are presenting our outlook for the natural gas demand in OECD Europe, and we do expect that this market will enter into a phase of structural decline over the medium term. The most important driver behind lower European gas demand will be the power sector. We do expect that gas to power demand would decline by around 25% over the medium term, and this is primarily driven by the continued expansion of renewables, which are expected to increase by 40% their output by 2030, mainly driven by solar and wind. Now, I also would like to highlight that this happens in a context when Europe also continues to phase out its coal and lignite-fired capacity, which is expected to drop by around 50%. And this also means that while the gas volumes consumed by gas-fired power plants will decline, the role of natural gas as a backup fuel in the power sector, in the European power sector, will increase and will play an increasingly important role in ensuring the electricity supply security of the European market, especially in Northwest and Southwest Europe. The second driver behind lower European gas demand is the residential and commercial sectors, where we expect that natural gas demand will decline at an average rate of 1% between 2024 and 2030 due to energy efficiency gains and continued electrification. Now, as we all know, these sectors are extremely sensitive to weather variations, and as such, the patterns will be also greatly influenced by winter weather conditions. Here, we did assume average winter weather conditions over the forecast period. In our base case, we also see a continued decline in industrial gas demand, which is partly driven by improved efficiency measures, but also some permanent closures in the European industry. So when we combine these factors, we see that in our base case, European natural gas demand declines by around 10% compared to 2024. If we consider the impact of lower LNG import prices, we see that there could be some demand response. And as we can see, most of that would be actually concentrated in the industrial and energy sectors, especially in the gas-intensive subsectors, such as refining and fertilizers. So we could see some incremental gas demand here due to higher operating rates. But even in that case, European industrial gas demand would remain 10% below its 2021 levels, highlighting that there have been indeed some structural demand destruction happening after the 2022-23 gas crisis. So in our high case, European gas consumption declines by around 8% compared to 2024. I think that one interesting question is, how will Europe's LNG imports evolve over the medium term against that background of declining domestic gas demand? And here we are presenting some of the key factors which could determine Europe's future LNG appetite. I think that one important factor to consider is the piped gas imports. And here we assume that the European Union will phase out its piped gas imports from Russia by the 1st of January 2028. We also expect less piped gas delivered from Norway and also from some of the other piped gas suppliers, including North Africa or Iran, which is today an important piped gas supplier to Turkey. In addition to that, we do expect that the piped gas exports from OECD Europe will increase, including to Ukraine and to Moldova. And then, of course, those two factors create more room for LNG imports compared to 2024, but they are partly offset by the lower gas demand. And also we expect some domestic gas demand production growth, which is very much supported by the development of the Sakarya field in Turkey, as well as the ramp up of Denmark's Tyra field. So when we combine all these factors together, we see that OECD Europe's LNG import requirements could increase by around 25% compared to 2024, and broadly stay flat compared to the levels reached in 2025. This also means that the share of LNG in Europe's primary gas supply mix will continue to increase from around 30% in 2024 to just above 40% by the end of the decade. Dear colleagues, this brings us to the end of our medium-term outlook related to natural gas, but please allow me to share also a couple of comments on the outlook related to low-emission gases. As part of our low-emission gases work program, we have a special section dedicated entirely to the outlook for low-emission gases, where we see quite a significant growth over the medium term. We do expect that the supply of low-emission gases will increase by more than 2.5 times over the outlook period. This growth will be largely supported by Europe and North America. And as we can see on this chart, this will be mainly driven by the upscale of biomethane and low emissions hydrogen, although we also see some room for e-methane towards the very end of the forecast period. Now, once again, to put this into perspective, despite this strong increase, the share of low emission gases will remain at just around 1% in the total supply of gaseous fuels by the end of the decade. So their impact on the overall global gas balance will be rather limited. If we have a closer look to the outlook for biomethane, we see that global biomethane production reached just over 10 BCM in 2024, and we do expect that it will more than double by 2030, very much supported by Europe and North America, but we also see some strong growth potential in Brazil and India. One comment on Europe. Here we expect biomethane output to increase at an average rate of 10% per year between 2024 and 2030, which is quite impressive. But of course, this is not sufficient to meet the European Union's non-binding biomethane target of 35 BCM by 2030. And in the United States, we expect biomethane output to more than double, very much driven by the transport sector. And also the tax credits under the One Big Beautiful Act will also provide some support to biogas and biomethane projects. So now moving to low emission hydrogen. We see a long pipeline of proposed projects in the low emission hydrogen space, which by 2030 would amount to 37 million tons per year. But as we can see on this chart, about 90% of those projects are either undergoing feasibility studies or are an early stage of development, basically at the stage of concept. And only 10% of those projects reached a final investment decision or are under construction. And when we consider only the mature projects, we expect that global low emissions hydrogen production would increase by around fivefold by 2030, and this growth would be concentrated in North America, China, and Europe, which together would account for 85% of the low emissions hydrogen supply by the end of the decade. And when it comes to e-methane, well, we see a number of project announcements, which I think in Europe are very much driven by Finland. And we also see a flurry of international partnerships, which are in particular driven by the great efforts of Japanese utilities and trading houses. On this map, we are showing a non-exhaustive list of the most notable proposed e-methane projects. And when we put them together, we see that global e-methane production could reach around 1 BCM by 2030, although I have to say that none of these projects have reached a final investment decision yet. I also would like to highlight that about 80% of that e-methane supply would come from LNG liquefaction projects, which highlights the perfect match between e-methane and the existing natural gas infrastructure. In our view, e-methane could play an important future role in the system integration of low emission gases and could also enhance the seasonal and short-term flexibility of the future clean gas systems in the longer term. Dear colleagues, this brings us to the end of this presentation. I'm very well aware of our time constraints, so I would suggest that we spend the remaining 5 minutes with the Q&A session. And I would like to thank you for your kind attention, and now giving back the floor to our host, Charlie. Thank you.
Thank you, Gergely. Thank you, Frederick. Yes, again, as always, sharp charts, clear trends. And so let's jump for the last minutes into a short Q&A. Frederick, you also answered one question that mentioned the Chinese domestic gas production. And Gergely, you already mentioned the EU ban on Russian gas imports that is planned for the beginning of 2028. From the IEA's perspective, what risks and opportunities does this create for Europe's supply security, and how can the EU best manage the transition, especially for member states still reliant on residual flows or indirect LNG?
Thank you so much for that important question. So we do see the phase out of Russian gas as a two-step process. First, the phase out of LNG, Russian LNG, by the 1st of January 2027, and then the phase out of Russian piped gas by the 1st of January 2028. In 2024, the European Union imported roughly 20 BCM of Russian LNG. That has been concentrated in 3 member countries of the European Union, Belgium, France, and Spain, but indirectly it has been also consumed in many other markets, including Germany. Now, we do expect that global LNG supply will increase by 40 BCM already in 2026. And in our view, in light of that strong increase in LNG supply in 26 and 27, the global energy market will have enough flexibility and liquidity to manage the phase out of Russian energy from the European market. And of course, some of those Russian volumes could be potentially redirected to other markets, including into Asia. Now, this, of course, would translate to more complex logistics, to higher, longer shipping routes. But once again, we will have more supply in the global gas market, and this would probably provide enough buffer to manage that situation. When it comes to pipe gas supplies to Central and Eastern Europe, this could create asymmetric situation for some of the countries which are currently relying on Russian gas in terms of market position. But at the same time, when we are looking at the question from an infrastructure perspective, there have been a lot of efforts made in order to improve the midstream interconnectivity in these markets, and the situation in terms of flows would be manageable by 2028 to reduce the reliance on Russian pipe gas by then. And of course, this could create then additional market space for alternative suppliers, including for LNG players.
Mm-hmm. Thank you. And then maybe let's have a short view on Germany. You mentioned the lower gas storage in Europe, but how would you assess the current gas supply situation and the outlook for the rest of the winter for Germany?
excellent question. I think that there have been some concerns in the beginning or earlier this year in Germany, especially some of the storage sites which had fill levels well below the European average level. I think in particular radon. Now, when we are looking at Germany today, storage levels are at, I think, just below 75% of working capacities, to slightly below the European average. Now, this being said, I think it is very important to recognize that Germany is not, by any means, is not an energy island. It is the most well interconnected European gas market, so it can rely also on other markets in that respect. But also very importantly, Germany has been doing very well in terms of scaling up its LNG import capabilities through the installation of FSRUs. And I think that, again, when we are considering the developments in the global gas market, in the global LNG market, this should provide also some comfort to the German market. Now, as mentioned during the presentation, the market fundamentals are indicating a calmer gas winter ahead. But geopolitical forces, unfortunately, can easily distort this picture, and we have seen that energy, and in particular gas infrastructure, has been increasingly under the influence of these geopolitical forces. So there is no place for complacency. And of course, these relatively low storage levels we see in Germany also means that the task for the next filling season to refill them to adequate levels might be more difficult, especially if we have a colder winter season ahead of us.
Okay, thank you very much, Frederick and Gergely. If today's sessions made one thing clear, is this: the global gas market isn't just changing, it's being redefined, and we'll keep following that transformation closely. Wir sehen auch beim Thema Gas stehen wir an einer Art Zeitenwende. Die geopolitischen Spannungen reißen nicht ab und gleichzeitig sehen wir den Beginn eines globalen Wettbewerbs um Versorgungssicherheit. Es wird interessant sein zu sehen, wie sich das globale Gashandelssystem in den kommenden Monaten weiterentwickelt. Vielen Dank an Sie, liebe Zuschauerinnen und Zuschauer. Wir haben heute ein bisschen länger gemacht, ein paar Minuten, aber ich hoffe, dass wir die meisten Fragen beantworten konnten. Die Präsentation und den Report werden wir Ihnen im Nachgang zu dieser Veranstaltung zusenden und eine Aufzeichnung finden Sie zeitnah auch auf unserem YouTube-Kanal. Ich wünsche Ihnen einen erfolgreichen Tag und weiterhin eine erfolgreiche Woche und bleiben Sie gesund und bis zum nächsten Mal.